Start. We have our first speaker with us now. Florian, you are here, no? Just to make sure that now we can start. So good morning good morning everyone from Brussels. It's a great pleasure to see you all. We wanted just to organize this webinar to have an excuse to wish you Merry Christmas face to face, and then to also tell you a bit the story where we are here in the ECBC and the Cover Bond Label Foundation, and what we would like to do next year. I hope that you have all received our Christmas message yesterday. I think that was a nice tentative to share with you the narrative that we are building. Here in Brussels, we have a new commission taking office. So the cabinets have been finalized a few days ago. Probably this will have a cascade effect on all the DG in Brussels. So all the commission will be realigned to the new political balance. That's a very important moment for us. As you know, we are your advocacy team. We are the people working to make sure that this industry will be able to serve the single market and continue to provide excellence, and also transforming the dreams of people in reality, which is our core business. In doing this, we are trying to collect the views of all of you, and the spirit of today is to share information with you, but also state very clearly that we are here to listen to you and to be ready to change what is our flagship, the label initiative, which has two sides, the cover bond label initiative and the energy efficiency mortgage initiative. Those are two faces of exactly the same story. The story is making capital markets more relevant, more efficient, less costly, and allow all the banks of the union to have access to capital markets very quickly. In a few weeks' time, I would like to announce something that is not in the list that I sent yesterday, but we are going also in the Baltics, because we see a lot of Estonian friends joining the cover bond label. And the cover bond label is playing a difference exactly in those kind of markets, where we see that they don't have a critical mass like a big country, but they need to access capital markets. And the cover bond label is making the difference for these issues, bringing them access to the market, cheap funding, execution cost, reputation, and there is a really added value in showing that they are a premium cover bonds or not a premium cover bonds in our website. So this is the service that we provide to the community. Last week I was in Pakistan, and there is
Questo qua cazzo è quello
Oh yeah. I can ask you maybe just if you're not speaking, if you can put mute like this, the call will be a bit more cleaner. Over there, also in the emerging markets, how to build up a capital markets tool is extremely important for all those markets, Pakistan, Indonesia, Malaysia, where we are acting and discussing with the Ministry of Finance how we can help them and support them. The point of reference for all this discussion is always the cover bond label. This successful story is really becoming a global benchmark for making capital markets efficient. And we want to thank you, issuers, investors, rating agencies who have been part of the success of this story. All together, we can make something really at a global level, move capital, and make the housing cheaper. The Danish commissioner who took office a few weeks ago in Brussels, he said, I have only three things important on my desk: housing, housing, housing. Well, the cover bond label, the energy efficiency mortgage label, are the response of the industry to this request to give a tangible impact to stakeholders and citizens. This is what we are doing. Today, we wanted to offer you an agenda and allow you to have a discussion. So please don't hesitate to interrupt the speakers, to enter in the discussion. We ask Florian, our good friend Florian, one of the major analysts of the cover bond space, to give us an outlook. We have received plenty of outlook from different analysts, and we ask Florian, as member of the steering committee, to share his view, to share what he sees in front of us, what we should be expecting in the cover bond space in the next 12 months. So thank you very much, Florian, for giving your views to us. We would like also to explain to you what we have done in the last 12 months to improve the cybersecurity of the cover bond label website. As you know, cybersecurity is the major concern of all of us. In Brussels, unfortunately, we had some bad experience, and we would like just to make sure that our IT infrastructure is ready to cope with whatever could happen in the coming months. We are also having very interesting dialogue with investors. We are continually on the phone with investors. We try to immediately react to their input, to fix problems, to see what to make their job a bit easier. And we are already receiving a lot of suggestions for the next revision of the HTT. So thank you very much to the Nordea team to contact us, to propose ideas. This has to be taken on board. So we will take very carefully their views on board in the next revision of the HTT, which will be discussed by the Cover Bond Label Committee starting from March. But we would like to share this kind of opinion and views of the investors with all of you. Because the awareness of our stakeholders is extremely important. In the same logic, we ask also Olaf, thank you very much, Olaf, for being with us, to share his opinion on why the cover bond label is becoming a real added value toolbox for investors, what we can do to improve this more, because we are always very careful on listening to this input and trying to make it more relevant for investors. And then we are very glad also to have the Bloomberg team on board. As you know, since September, we have decided to insert in the HTT the option for issuers to insert the FIGI, which is a kind of car plate for the cover pool. And we are very glad to have Sven here that will explain a bit better what they are doing. And this is the spirit of this kind of implementation is to make the cover bond label more relevant, more efficient, more transparent, and improve the quality of the data on both platforms, the cover bond label platform, but also in Bloomberg, and maximize the quality control. With this, I will conclude by giving you the agenda for next year. So, I mean, I'm sure that you have seen this in the email that I sent yesterday, but at the conclusion of this meeting, I will give you the list of the upcoming ECBC event. With this, Florian, I would like to give you the floor and thank you very much for the good job that you do for the entire community. Florian, the floor is yours.
Thank you very much, Luca, and good morning, everyone, from my end. As Luca said, he asked me to have a few. All right, is the screenshot showing or not longer?
Not yet from my side. It's
Okay, is it now?
arriving. Yeah, now is it.
Okay, there we go. So yeah, he asked me. I mean, Luca asked me to say a few words on the outlook for covers, and it's been, put it that way, a reasonably interesting year, especially a reasonably interesting Q4. And the reason I used a black let's say backdrop for the title slide here is because reasonably interesting in the last quarter at least meant reasonably negative, meant a lot of volatility on the spread side, markets in primary space that weren't exactly open, or at least not flying. So it was a really tricky end to 2024, I have to say, with especially some of the usual classic pricing reference points that we all use, kind of moving into almost free-fall mode, you could say. You had bond asset swap spreads moving materially, SSAs widening out quite meaningfully, and cover bonds being dragged along on the right as well. However, I've not only used a black backdrop, but also a feisty little, actually fairly positive at the end of the day, looking girl there, because I think it's anything but doom and gloom when I look into 2025, or it's rather a matter of tenor choices, or parts of the curve you want to be active in as an issuer or as an investor, because there are quite a few, I would say, fairly positive elements that need to be stressed from my end. And I've been traveling pretty much nonstop the last 3 weeks. I've been seeing clients in Vienna and Bratislava, then 2 days in Paris, then Berlin, Hamburg, Hanover, Stuttgart, Munich, Paris I've mentioned, London 2 days, and it's reasonably positive feedback, I would say, that I've gathered with a lot of the investor base actually looking at this in a fairly positive light. And on the issuer side, and that's maybe where we can start. The supply picture doesn't exactly look like we are faced with a huge surge of volumes into next year. I mean, I do have a marginal increase compared to this calendar year, but that's more a function of a slightly bigger issuer universe being active in 2025. I mean, we, for example, just one country, and we will have the ECBC plenary in Athens next year. And it's not without a reason that we have the ECBC plenary in Athens next year. I mean, there's a restarting of issuance activity from that jurisdiction. We have a few other jurisdictions that haven't accessed euro benchmark markets this year. You know, New Zealand is one example, or the Swedes have been very, very quiet with their focus mostly on Swedish krona, Norwegian krona. So it's more a story of a few issuers either starting to issue or resuming issuance into next year, rather than individual banks doing materially more. In fact, if I look at individual banks, a lot of the large issuers that are typically driving volumes up are effectively looking at less funding needs into next year. Just one example, some of the large French banks will most likely have overall funding needs down a good 15% across their entire capital stack. And that, of course, also then means less funding on the covered bond side. If you think about relative pricing across covered and senior, you have another sort of situation where covereds will most likely not be first choice. Because if you take, I mean, I work for Crédit Agricole, so take Crédit Agricole 10-year or any French 10-year covered. At the moment, you'd be looking at mid-swap plus 80, give or take, and the senior in 10 years is inside 100 basis points. So you've got a really, really narrow spread between the two products. And I can tell you a lot of the issuers, and that's where we can already start talking not only about overall volumes, but also the timing and sort of pace of supply into the new year. A lot of the issuers at this point would rather focus on senior preferred, senior non-preferred and tier twos rather than open the year with huge cover bond volumes. So I have the overall volume up marginally, but again, more down to growth in the issuer universe rather than individual banks doing more. And in terms of the timing of it, I think we'll be looking at a very, very quiet January by cover bond standards or by any market standards. I mean, January being the start of the year is always busier than, I don't know, August or December for sure. And that's what we'll have in 2025 too. But when we had January volumes in 23 and 24 above 40 billion, that's something we will definitely not see into the new year. To some extent, because we have calendar effects, the 2nd and the 3rd are sort of Thursday, Friday, so that week is a bit broken, and then the 6th is a public holiday, so that's another broken calendar week. Some banks move into blackouts earlier this year, so it's to some extent down to that. But as I said as well, it's also down to individual banks needing less, so there's less pressure to jump in and be big early on. There's a product choice element, so issuers rather going senior preferred first. Because of spreads being relatively tight to covers. And there's a last element here, or two last elements. One being this calendar year, so 2024, a lot of issuers, both banks, but also SSAs, were looking at the second half saying, look, there's so many political risk events, we'd rather get our stuff done early. And you had the SSAs, for example, at 70% funding completion by the first half. And for many banks, it was very, very similar. This time around, the starting point is rather that there is no such clearly visible, let's say, H2 risk event that you could focus on. Instead, you have banks and SSAs, for that matter, that are looking at valuations that are really, really wide. And I've come across quite a few that would probably rather hope, whether or not that hope is justified, we'll get into in a little bit, but still hope that they can ultimately fund at a slightly tighter level at some point later in the year, rather than be the first one to crystallize where relative value sort of really is at this point. So size-wise, marginally up, bigger universe, and less frantic pace at the start of the year. In terms of net supply, that's important to note as well. We're continuing on a downward trajectory. I mean, we had two really heavy years when banks were repaying the TLTROs. That's pretty much done now. I mean, the last remaining residual teeny tiny volumes of the TLTRO are history by the end of this year, and therefore that's no longer a driver, and therefore net supply has already come down this calendar year to around 40 billion. Next year is another 30 billion. And if my gross forecast is too high, of course, that means net supply would be even lower. I know the range from my dear friends and fellow competitors in this market, I think I'm towards the upper end of it. There's some that are also forecasting more 140, 145 billion, in which case we would effectively be net flat more or less. So supply to me is not a negative element. It's not a driver that would lead to materially wider levels. Again, pace is not going to be frantic, and the overall volumes are not huge, and the net supply isn't big, and I think is easily absorbable. Tenor choices, that's one last point on the supply element, will have very, very little long end supply from what I gather, because of spreads having moved as much as they have, because of especially sub-sovereigns and agencies and supras being as wide in the longer dated tenors as they are, means to access markets in a 10-year tenor, banks will really have to pay spread levels that they're usually used to from senior preferred space rather than from cover bond space. And I get the impression that a lot of banks, again, given the relatively small amount of pressure they have to fund and raise sizable volumes, would rather move into slightly shorter tenors. And we'll get to investors in just 1 second, but that's ultimately where the bulk of the buyer base is concentrated. And that's where even a slightly bigger concentration in certain parts of the curve will not have a meaningful impact on valuations, because absorption capacity is big there in my view. So net supply is slightly down, and therefore supply as an entire topic as such is of course relevant, and you need to have a forecast as an analyst. But at the end of the day, it's not going to be the one element that will drive the market next year. I just can't see that. I mean, we have a bigger increase on the redemption side in 26 and 27, but quite frankly, that is not yet going to be big on the supply for 25. Maybe some bigger volumes in terms of pre-financing at the end of this calendar year, as banks anticipate the 26 and 27 numbers. But again, that's more around timing of supply and maybe making it a slightly more broad-based across the entire calendar year. But the main thing for you to take away is we're back in a more normal environment with all of the central bank facilities having been repaid. We're now looking at balance sheet metrics being the main drivers for supply and redemptions. Redemptions will become big in 26, 27, but not yet 25, while bank balance sheet dynamics are not calling for big increases on the funding side. Loan growth is timid and deposits are really sticky. So again, at the end of the day, supply will be there, but it's not going to become a big driver on the valuation side. I just spoke about absorption capacity, and I've had, as I said as well, a lot of meetings these past 3 weeks, plus of course regular interaction even before hitting the road, and I can tell you it doesn't feel like we are seeing people leave. I mean, I use "don't go away" from Oasis here. I think people will not go away. I think they will actually stick around, and we'll actually see more actors joining the cover bond space. And that's maybe the main takeaway and the main point to mention here. It is, however, something that you can't extrapolate or assume is equally valid across the entire curve. There are new actors joining, or those that have been around this year and slowed down in the second half, resuming their activity. But the bulk of the interest, it feels, is concentrated out to 5, maybe 6, maybe 7 years. But beyond that, it does become relatively hit and miss, or you really then need to worry about what the Bund asset swap does, what the European Union does, focus on SSA supply and the levels that they print at, because there you do have veritable competition. But out to 5 years, we're actually looking pretty good. We had, just to go through some of these buyer bases here and tell you what they will most likely do in early 25. We've of course had banks. They've been the biggest buyers in cover bond space and historically been the biggest buyers. They had a bit of a drop this year, but that was I would say more a function of the asset managers becoming slightly more active. So more along the lines of banks choosing or issuers choosing along the lines of who do you want to allocate more, rather than the actual orders dropping materially. What they've experienced, and I said it at the very beginning, and that's why I had this black backdrop for the title slide. What banks have experienced these past few weeks is effectively them losing the entire P&L for the first 9 months in 3 weeks. I've come across that a few times, that classic HQLA buyers, so liquidity portfolios, told me that this Bund asset swap spread move with 10-year Bunds or Bund asset swap moving all the way to -7, -8, so Bunds ultimately trading above swaps, that's cost them. And you're talking about a lot of bloody noses and a lot of teeth that were basically not pulled but smashed in, and a lot of investors in that group basically trying to limp into year end without any further damage being done to their portfolios. So they had zero cares to be active most recently. They first of all had the bulk of their buying and their volume targets completed by end H1, and then Q4 really piled a lot of pain onto their desks. Start of next year, banks will have new volume targets that they need to complete, and it makes sense to buy bonds over ECB deposits. So they will be active buyers, but, and that's where kind of this one comes in, if you've just had volatility in your portfolio spike, and if you've just had massive losses on the holdings that you had because of the Bund asset swap spread move, and you move into the new year and you look at a market where all of a sudden even 3-year spread levels are as wide as we previously had 10 years or longer dated bonds, then what most banks will do is calibrate the portfolio to meet their target, but do it with a minimum duration. And therefore, a lot of the ones that I've met these past 3 weeks are telling me, of course, cover bonds make sense. And the shorter tenors, they still make sense versus bonds. They still make sense versus SSAs, and they make sense versus ECB deposits. So they will be big buyers, but don't expect bank treasuries to be a big buyer base in 10 years and beyond. They will be very, very large in the 3 to 5, maybe 6, 7 years. But that's where things will end or be concentrated in. So bank treasuries, I'm quite positive. It's just a matter of tenor, and the moment you want to go long as an issuer, don't expect them to be there, because, as I said, the memory of the last few weeks is still very, very vivid in many of these people's minds, and they will not try and be heroes and not try and go too long and add duration for a few extra basis points. They will try to again calibrate their portfolios to reach a target with the minimum duration possible, and then at some point later in the year maybe think about terming things out when we've had bonds move further and wider against swaps. The other buyer base that I do want to mention is these guys here, real money asset managers. That's where I've met a lot of people that I hadn't met before. That was mostly the start of 2024. I saw a lot of credit investors that I'd never met before. They slowed down the second half because they bought a lot in the first half, and then saw dynamics in the market kind of deteriorate. So there was no more an aggressive case to add even more. But if you think about where we start 2025 versus 24, then you quite quickly realize that we're even tighter versus corporate credit. We're even tighter as a cover bond market versus senior preferred. And therefore, a lot of those that were kind of slower or calm, quiet in the second half will be back, and I think we'll even get more credit buyers to join the market. I had 2 days of meetings in London, Monday, Tuesday this week, and a bigger focus on covers was one theme that was mentioned by quite a few of the real money accounts that I saw, with sometimes the people that I have met in the past saying some of their credit colleagues with at times far larger volumes will be ready to join in early 2025. So the one group in that, let's say, bucket that may be slightly less busy is classic rates investors. I mean, they may focus on a European Union or on govies, but the credit buyers will be back at the start of next year, and possibly with bigger volumes than at the start of 2024. So banks resuming purchases, short end asset managers, above all credit accounts. So the wider you spread, the better at the end of the day. A very tight German fund brief is maybe not going to get the attention from a UK real money account. But if you're a French issuer and you're issuing in the mid 50s over swaps in 5 years, be sure you can be sure that there'll be a few 100+ million tickets from these type of investors. The last group that I do have to mention is these guys, because those are the ones where the overall percentages haven't changed, but there's a lot happening underneath the surface. If I were to show you a chart with the distribution by month, you would already see that in the second half they've picked up the pace. And it's not just because the others have slowed down and that their relative share has gone up, they've actually increased the absolute pace as well. You have two trends. One being the Eurosystem members, so the various national central banks, are nowadays no longer constrained by quantitative easing. You have the APP in full runoff, we'll have the PEP in full runoff, so QT, and they no longer have to deal with not being allowed into Eurozone assets because that's where the QE colleagues are buying. They have full flexibility again if they want it. And some of the Eurosystem member banks have already used it this calendar year. There's been, the Bundesbank has restarted buying in more active terms. The Banque de France has bought since the start of the year. You have smaller Eurosystem member banks such as the Slovakian central bank that is all of a sudden one of the largest buyers in cover bond space again. Throughout QE, all they could do was buy a few Slovakian government bonds and the odd primary transaction out of the country, and they were effectively banned from doing anything else. Now they've regained their flexibility, and some of the other Eurosystem member banks will try to get there as well. And some of them will be there at the start of the year, others maybe throughout the course of 2025. But that buyer group, the Eurosystem itself, is becoming more active and is taking a more hands-on active portfolio management. You make active decisions as to which asset class you want to favor, which tenor, which sector. They will move there. Some have already done so. Others will do so again. So we're not peaking yet. It's still work in progress. It's still something that is ongoing and adding more interest and demand to cover bond space. And last but not least, you have some non-Eurosystem central banks that are also looking at covers in the shorter tenor, saying it still makes sense versus govies and SSAs. The absolute spread levels are wide enough for their internal, let's say, hurdle rates. And therefore they've been buying in bigger sizes. And very last but not least, I still have discussions, not so much with Asian central banks, but with some other Nordic CE style, central bank official institutions, buyers that are also starting to look at covered bonds. So, from the buyer base, I don't sense any constraints as such. I don't sense that the amounts that I mentioned on primary earlier would be challenging to absorb. Where it is a challenge is in the longer dated tenors. That's where the competition with SSAs is much fiercer, and that's where the normal, let's say, base of investors that I just outlined is simply less comfortable to go. So you have a smaller pot of potential buyers and more competition from other asset classes. In the shorter tenors, you don't really have the competition in a very, very large pot of buyers. So it's in out to 5, as I said, maybe 6, maybe 7 years, where the demand and supply dynamics into 2025 are actually quite positive, and where the bulk of the pain in a way is effectively behind us. It's more on the 10-year part where and beyond where I'm still let's say a little nervous as to spreads into 2025 compared to where they are at the moment. But that on supply demand. Let me just quickly outline one other point that I've come across quite a bit these past few weeks, and we're not talking about cover bond directive implementation. I mean that is effectively done, and of course the EBA still has to produce their reports. But from what I gather, and Luca, correct me if I'm looking at this the wrong way, but from what I gather is the EBA will produce something by mid next year. The Commission will take it, put it in a drawer, open it, close the drawer, and forget about it, which is good in a way for European issuers because it means what you have now is what you'll have going forward as well. There's no disruption from European regulators, I don't know, adjusting or changing rules on extendable maturities or doing anything that could mean higher cost for the issuers running their businesses. But what it also means is for third countries, their hope of getting a lower risk weight and a better LCR treatment, well, that will have probably just been pushed further down the line because of the focus that the Commission has being on securitization at the moment. What I have come across, though, and where regulation does matter, is in the CRR3 implementation and in terms of risk weights and how banks model their internal risk weights for covered bonds and other asset classes. And it took me, to be honest, a little while to realize and figure out why exactly there were shifts and changes, because the high level input parameters into all those models don't materially change. What does change for cover bonds is you're no longer allowed to use the internal ratings-based advanced approach, so everyone will be pushed into foundation. And what has changed as well is that some banks will be more coming from supervisory practice than the regulatory changes, will also be asked to change model for certain asset classes. And the impact that these, let's say, more subtle and underneath the surface type changes have is for cover bonds, especially for third countries. A lot of bank treasuries will ultimately have bigger risk weights or higher risk weights than they have at the moment. And the extreme case in that context is UK banks, for which everything non-UK is third country. So a German fund brief for a UK bank treasurer is a 20% risk-weighted asset. And for them, this implementation really means covered bonds risk weights go up to the point where at current pricing levels, they no longer make any sense whatsoever. I've had a few meetings this week where the UK bank treasuries that I met said covered as an asset class is no longer investable because it no longer makes sense. So the collateralized investments they do is on RMBS, and at the same time, their entire sovereign and sovereign risk, so also SSAs that are treated as risk to the sovereign, they are getting moved onto the standardized approach. So they moved down to 0% risk weight. So what the UK banks will effectively be doing is buying less covered and buying more KfW, buying more govies, buying more gilts. That's the impact it has on the UK. So any of the issuers that want to do sterling, well, that market has just become less deep than it was before. For euros, however, it feels like the impact is actually not the exact opposite, but is rather positive than negative, because I know some banks that in the past have been using the RBA, but have been fairly conservative in their modeling. And for them to be forced into the foundation means risk weights can actually go down. In some cases will go down. So across the European Union, I think bank treasuries will have neutral to maybe even slightly bigger capacity to take on covered bonds. And the one area inside the European Union that is negatively impacted is rather 20% risk-weighted SSAs, where effectively what I just described for UK banks and their cover bond exposure is what happens for them, like a BNG, Netvarashaps, or some of the French smaller agencies, AFD, BP, France. They may have their risk weights go from 3 to 4% all the way to 15, 16. So you will have a rebalancing away from them towards covers and sovereigns. So it's, again, not a very, very visible, transparent topic, but if you dig one level down, you can see that there are some shifts in the buy base that will take place. Sterling rather negative, euros rather positive, I would say.
Florian, yeah. I was discussing yesterday with the chair of the ECBC about your paper, and we were all agreeing that it would be nice to discuss this point in the steering committee and to analyze the implication for the different jurisdiction and different currency. So, I mean, probably Stefano will ask you to present this in the next steering committee and to give your view. So just to alert you that this is something that we would like to address in the steering committee level.
Cool. We'll do.
I see there is also Mark with one question.
Yes.
I don't know if Mark is a good moment. You are muted, Mark.
Yes, hello everybody. Sorry to interrupt. Now, can we get back to the last slides with the impact of the change of yes? I just have a question for you, Florian. The average RWA retail mortgage IRB exposures are, I understand that they are on the left, on the right scale. That's correct? Because we have all these points, which I understand represent the current RWA of the bank.
Sorry, that's right-hand scale. Absolutely.
Yeah. Which means, for example, I'm taking Crédit Agricole, the first bar, the second bar from the left. So they are roughly a little bit above the 10%, which is basically what I have in mind, which means the output floor should have kind of stringent impact, because we're talking about, let's say 14. It's difficult to read, but let's say 14%, 12% RWA. The impact of the output floor is not that, I would say, it might be quite significant. Because all those lines that are just well below, I would say, see.
Well, from what I understand from my let's say capital solutions, or the guys that I basically have this chart from, is output floor itself is becoming relevant for banks at some point 27-ish, and maybe even slightly later. So it's not yet a constraining factor as such. I'm more, as I said, the story that I want to, or the points that I do want to make is more around HQLA portfolios and how banks look at this, and how they, let's say, size minimum spread thresholds that bonds need to meet in order for them to make sense to invest. I mean, it's this is again more of a general chart that I borrowed from my colleagues.
Very interesting.
But again, I mean, this sort of stuff we can still discuss. So away from here. But I've already used up 23 minutes, and I've been given half an hour by Luca. The last point that I just wanted to make on valuations is all of the topics I mentioned before. So supply, demand, the banking regulatory topic are relevant, of course. But for valuations, what is almost dominating all of those topics is Bund asset swap spread. The Bund asset swap is ultimately the one thing that's been behind the widening that we've seen already in both SSAs as well as in cover bonds. Because if your floor that you've until now had a big buffer against gets pushed up, that ultimately pushes everything else up as well along the way. There's of course an element of covered bonds offering an extra buffer and therefore being able to withstand some of the pressure from underneath, but you cannot fully decouple. On covered bonds, to look at this chart here, just to make it easy, you have a beta of minus 0.5 for the sake of the calculation. So if bonds move 10 basis points wider versus swaps, you basically have cover bonds outperform bonds by 5 basis points, but they get pushed up versus swaps by 5 basis points as well. So it is relevant to see and have a view as to what happens to the sovereign and to the bond curve. And the bond curve is the one thing that my rate strategy colleagues have a very, very bearish view on. I mean, they basically have bonds trading at 30 basis points above swaps by the end of this coming calendar year, which means there's a 30 basis points move that they expect. Just to have a few numbers in the back of your minds and to see the point that I'm trying to make. If you have bonds at 30 over swaps, yes, cover bonds will outperform bonds, but you have bonds at 30 over, a KfW, a classic SSA name, then maybe at 45 over. If you have KfW at 45 over, Bundesländer at 50 over, and a 10-year German Pfandbrief will really struggle to be inside 60. And that's a good bit above where current secondary levels are. And that's where the black background from my title slide kind of becomes relevant, because at that part of the curve, you have, first of all, a shift in the buyer base that is not exactly favorable, because a lot of it gets pushed into slightly shorter tenors, and you have a move in the underlying pricing reference rates in a way that is potentially moving up quite a bit. My colleagues, and to make that point and to come back to the feisty little girl, they don't have the same view on 5 years or below. In 5 years, just to have the same analogy or the same cascade and pyramid of numbers, in 5 years, they expect bonds to be flat versus swaps. So that's a 10 basis points move. If you have them flat and the KfW is at 15 over at the moment and German Pfandbriefe are 35 over, you have differentials that already make sense. You have a spread buffer that's already big enough for the cover bonds to kind of stay where they are and not really have to move. And also not have to move throughout much of the coming calendar year. So there's a deeper demand pocket in this part of the curve, and there's less pressure from competing markets in a way. So I'm quite bullish in a way overall on a lot of these let's say both sectors as well as the cover bond market as a whole. But it's really yeah, important to me to highlight that it's about tenors and not something that you could let's say make a point across the entire market and not have to worry about what curve point we're talking about. So covered as an asset class, as I said, deep demand, supply relatively limited, net supply down. Not a very hectic start to the year, so slightly more spread out over the course of the year. So all those points are positive. What is the negative at the end of the day is bond asset swap spread move, and that is something that is above all driven by an increase in free float on the bond curve. You have the ECB running their portfolios off. The by far biggest absolute amounts they own are in bonds, so those need to find a home. And banks, as I just said earlier, are happy to add, but not in long tenors because they've just been getting a bloody nose these past 4 weeks. So it's the long end that still needs some. Somebody's talking. Needs well, is not quite at the end of the journey yet. Put it that way. And the European Union issuing 90 billion in the first half was still a very strong focus on duration, is sort of kind of adding to that. But as I said, as an issuer, if you need tenors out to 5 to 7 years, 2025 is going to be a year where you don't face a whole lot of competing supply, where you can pick your windows and where demand is actually going to move in your favor. It's only if you want to do long end, then you really need to think hard about timing. And waiting until the second half may not be the best of ideas, because if that bond asset swap spread move happens, then levels are going to ultimately be wider versus swaps at the end of the year. So it's, as I said, a relatively, I would say, positive start to the year, because we have less pressure from supply. We have levels versus senior and versus credit that are tighter than they were at the start of last year. We have outright yields that are not much different from where they were last year, and we have levels versus swaps in many cases that are actually wider than where they were at the start of this year. And therefore, I'm more focused on the little feisty girl than on the black background, I have to say. But with that, I think I would stop sharing that. And again, happy to jump on a call with the steering and Mark, when we can discuss the risk weight density and input output floor impact on banks at a
sure
different.
Florian, as member of the steering committee, can I ask you, and one of the best analysts of our industry, what are the 3 major points that the steering committee should look at next 12 months? For example, I mean, in those days in Brussels, there are a lot of discussion about digital Europe, digital euro. You know, I mean, there is a big concern of the savings banks that this can actually change the world of the deposits and how the deposits will be managed. I mean, do you see any implication, what we can do as a covered bond community? What are the major focal points where we should be discussing as a community?
That's a good question. Well, I suppose with all the focus on securitization, which is perfectly fine to have, because that market needs to get improved as well, or needs to move forward. I mean, that's basically been killed quite effectively by regulators a few years ago, and we both need those working in parallel, just to make sure that they don't completely forget about covered. I would say digital euro. To be honest, I'm not sure what the actual policy push would be. From what I understand, so far we're talking about relatively small amounts that are going to be allowed per individual. So the overall impact, I'm not sure that's going to be big. Rather, for the time being, deposit bases and volumes have gone up rather than down. If you take a little bit away from that, for that, fine. But I'm not sure that's systemic as a risk. Now I would just simply say we kind of need to keep fighting for our good friends abroad. That this doesn't completely get forgotten, because I think there's a veritable case to be made to have the third country equivalence in the end, and I'm a little bit afraid that will ultimately just be again pushed to the side because of the focus having shifted. So we just need to make sure they don't forget about that at the end of the day. But Antonio?
I think from that point of view, Florian and Luca, I think that the moving forward of the digital euro may be one of the opening, or one of the ways to facilitate the implementation of digital transactions. What I mean is that at the end of the day, the adoption of the digital Europe, of the digital euro, was an event that was expected, evidently, to kickstart the adoption of digital currencies in different transactions. So it may be the case that itself is not an element that will change the market, but it will probably allow other institutions that are working in digital transactions, and I think we have discussed in a number of panels and a number of the adoption of the digital euro and the in the covered bond market. It may be the case that the adoption of the digital euro kickstarts, in a sense, institutions to be able to start structuring transactions in a digital way. I guess is my point. Okay.
Maybe as a follow-up on securitization, Florian, that was our big effort to produce a securitization paper. Thank you to the ones who have participated in this kind of drama. I think just to give a feedback to our community, our position paper was the first one to be published by Federation Brussels. So we were very efficient in delivering this. Was very balanced, and we got some feedback from the European Commission and EBA that were very good. They like the idea of our HTT for securitization. They said disclosure is a big problem, and we should learn from the covered bond label. So I think compliments to the entire community, because the HTT has been perceived by the European Commission as an excellent example that can be duplicated in other markets. So, but of course, we are on the ball. The securitization discussion is very relevant for our community, and yeah, we are following the dossier very closely for everyone. I don't know if there are any other questions for Florian, but of course, I mean, Florian is also always available as a member of the steering committee. So if you want to contact him, I mean, just send us an email. We will bother him for this. Flo, thank you very much. I know that you are busy. So, I mean, thank you very much for your time. It was an excellent window and an excellent way to start the day. Thank you very much, Flo.
Thank you, Luca.
I mean, going back, we all know how important is the covered bond label and how important is the covered bond market for the future of the housing market in Europe. And we don't want to make any mistakes. So, I mean, since last year, we had a small cyber attack on the EMF side, so nothing to do with the covered bond label, but that was, I think, the trigger for us to open up a very deep due diligence audit of all the IT system in under our umbrella. And of course, the majority of our attention was towards the covered bond label and the energy efficiency mortgage label. So we have invested an important amount of our budget to make sure that we had a review of the website and trying to make sure that we were implementing the right solutions. We have done 3 things, and we would like to inform you that one of those is operational starting from last week. The 3 major suggestions that we received from our audit, it was that, first of all, we should have a server that should put back in track all the information about the covered bond label in a question of hours. The previous website had a 24 hours reaction time. So we were able to have a complete backup and re-put the backup up and running in 24 hours. We felt that this was not enough because the covered bond label has a serious market relevance. So in case of one of operation, in the middle of one of the operation into the market, we should be able to reinstall everything in 3 hours. That was our request. So we have changed completely the server. We have changed completely all the IT infrastructure in order to allow the covered bond label to be back in track in 3 hours in case of a cyber attack. Probably you know this, but I mean, in Brussels, most of the federation, most of the European institutions have been having attack over the last months. The frequency of the attack is increasing and is arriving on all sides. So whatever federation has been having those kind of problems. So we felt that we could be a target, and we have activated this now starting from September. This option is fully operational. The second issue that we have been implementing is a 2-factor authentication, which is now normal practice. Now we were very concerned because making difficult for lenders, for issuers to charge their information on the website could be a critical bottleneck, because we need you to charge your information quickly and rapidly on the website. At the same time, after a deep analysis with several consultancy, the risk of keeping the doors too open, it was too high. So we have decided to install on the back office of all the issuers, and this is operational starting from last week, after a test done by us as a staff, a two-factor authentication. So when you charge the information as an issuers, you have to use a double-factor authentication. You can remove this option, but we have put by default that you have accepted to use this. So we invite all of you to use this option, because it will make the system much more resilient and robust. We have put in place all the measures that should be trying to protect the website. Also, what we have done, we have a quarterly review, a quarterly audit to make sure that the website is fully aligned with the best practices in Brussels, but also from any point of cybersecurity point of view. So this is what we have put in place. That was a very brief presentation, but maybe Jacopo, if you can go more in details, like this, members can have a demonstration of what they have to be doing on the back office. Of course, we have done this for both the cover bond label and the energy efficiency mortgage label. Jacopo, I'll give you the floor. Thank you all for your dedication to the cover bond label.
Luca. Good morning, everyone. I will be presenting you, as Luca just explained, the steps to activate the two-factor authentications on your accounts. So the idea behind the two-factor authentication is that we realized that, as Luca was saying, considering the growing importance of the cover bond label and the growing importance of the data that is stored on the cover bond label, there is the need for issuers to ensure that they cannot be attacked and there cannot be a change in the data that they report. Considering that I see that, for example, we have Sven on the call from Bloomberg. Also, Bloomberg is taking the data, and we cannot guarantee, but we're trying to do the best, to make sure that there are no external attacks. So what we did was adding this two-factor authentication that we try to keep as easy as possible in order not to create any kind of bottlenecks, and simply as of last week, when you access your cover bond label or energy efficient mortgage label account, we took screenshots from the energy efficient mortgage label account, but they are the same interface. You will see this let's say message that tells you that the account is not protected with enhanced login security. So you would need to follow the set it up now link, and this will lead you to the second page. That is the one that will allow you to enable your two-factor authentication. We asked our IT providers to make sure that all the main, authenticators that are available on Apple Store and on Google Store would work, to make sure you don't have to download any new, because we also understand that there is one for the email, one for LinkedIn, one for Instagram. So we just want to make sure that it can be as easy as possible. You will need then to scan the QR code with your authenticator app, and once this will be done, you will see you will need to go to enable two-factor authentication and input the code that will come out on your authenticator in the authentication code space. Now, one important thing, because we've been checking, and there is always the difficulty to strike a balance between security and making it easy for you issuers to users of the two labels to access your profile. So we suggest to once you activate these, make sure that you always choose to remember you on this device. This is because in the moment you don't do this, you will be locked out every time you close the page, and you will have to redo the whole two-factor authentication every time. So to make sure for you to, in periods like this one where you have where you had the renewal of both labels, or in periods where you have to update your HTT or HDT or HRT, it can happen that you need to access the page more than once in a day. And we made sure that if you remember yourself, like if you do remember me on this device, you will be able to access without the need of two-factor authentication for the next hours from the first access. This was the idea behind this, was indeed, as I said, to make sure that it's smooth. You can just access as you always did, but you simply have a better security for the data that you store that is of increasing importance. So these are the main, let's say, new features of the website. And yeah, Luca, I will give it back to you if there is no questions from.
Yeah, I mean, I would like just to open the floor for questions. We are recording this kind of event because the idea is that, Jacopo, we should send this to all the issuers, all the ones that are working daily they should have
Sure.
access to this video like this. They can, but I mean, myself and Jacopo, we are at your complete disposal. If you have problems, we know that IT can be a problem. We are here to fix it. Also, if there is a bug or something that you find very uncomfortable, please let us know. We are always ready to find a solution. I would like just to double check if there are any questions or any comments. It was a lot of investment, I would say, in the brain capacity, try to find a solution which will not disturb you. At the same time, it will increase the security of all of us in the right way. Please let us know if you have any comments or questions. Well, I don't see any questions, so I mean, I will say that, I mean, it was a successful landing. I mean, if you have any problems, let us know. We would like to move now to the investor section. It is very important that we listen very carefully to the investor community. As you have seen in the last event, we are giving more and more importance to the investor voice because they help us in making all the infrastructure helpful. The cover bond label is mainly a machine to help investors to enter quicker and more efficiently in transaction and making the cover bond market more efficient. So that was the real target of the cover bond label. So in this spirit, we continue to listen to them and trying to find solutions for their daily work. I think we have Niels and Ken with us. I don't know if they are already online.
Thank you, Luca.
Thank you very much. Allow me to say that, I mean, we are organizing the Factbook Working Group and Data and Statistics in Tallinn on the 12th of February. We are discussing now with the Estonian friends. The idea is to have a round table on cover bonds on the Baltics, as I said. So there are, and they ask us to bring some investors. So Niels and Ken, if you want to come with us on Tallinn and having a nice dinner with us, it will be highly appreciated that we can continue this debate face to face. So, and the same, of course, Olaf, is valid for you. It will be 12.
Sounds interesting. Yeah. Unfortunately, I'm away on paternity leave in February, so I have to ask my wife before at least.
I fully understand. So I mean, okay, but I give you the floor. Thank you, Niels, for being with us and for raising this issue.
Yeah. I can maybe just start by emphasizing how important the HCT is for us investors as well. We it's very important for us as investors to have easy and comparable and harmonized information about the collateral backing the covered bonds that we buy. So we encourage all issuers that we talk to use the HCT. And then we also have a small wish that it will become easier for us investors to gather the data from the covered bond label webpage. We are being approached by companies that are trying to sell this information organized in a way we would like it, but we think it would make more sense if we could extract the data more easily ourselves. But now we will have more focus on the sustainability data behind the cover pool, and there I have brought with me Ken from our responsible investment team, who has worked quite much on a model that is quantifying the sustainability level of covered bonds.
Yeah, thank you very much. So this Luca, he asked us to do the 15 minutes version of this, so it's quite condensed. If you wish to discuss our sustainability models or the other models that I'll be going through in this call bilaterally, please give me a call. We have had this discussion in different degrees of detail with 67 issuers across Europe already, and we are more than willing to have more discussions with you because this is highly important for us. Let's jump into it. Do you see my screen?
Yes.
Great. So we have three needs for sustainability model data from covered bonds. One is sustainable investments according to SFDR. All our funds with covered bonds, they have limits on sustainable investments. So far, the limits have been set rather unobtrusive because they have been put onto funds that were not born with a significant ESG integration. But so we use it for, in our current funds, for reporting purposes mostly. But we are discussing with several institutional clients across Europe who have asked us specifically how we can construct an ESG integrated product for covered bonds. Our response to that is that we do not believe such a product should be based on the ESG scores of the issuers. We do believe it can play a role, but it is not the material part. So sustainable investments, that's one way you can do it. We have also, as a group in Nordea, we are part of the Net Zero Banking Initiative and the Net Zero Asset Managers Initiative. So we have, of course, set targets for sustainable investments. We will include covered bonds in that under certain conditions from this financial year, so in next year's financial report. I'll go into details on how our model for that looks like, and then it will become very apparent for you why we need this. Our clients also need it because many of our clients, they are also part of the Net Zero Asset Managers Initiative, and we will, of course, love to be able to tell them, if you buy this product from us, we will ensure that the assets are managed in line with net zero so that they can live up to their commitments. So these two parts for us as an asset manager, they become competitive parameters. And we would like for you to provide us the data so that we can beat competition. The last part, that is reporting of financed emissions. So to my knowledge, all issuers of asset managers, when they report, if they report financed emissions on their covered bond funds, they use the issuer's financed emissions per million because there is no methodology from PCAF on how you should do it on covered bonds. Last week, such a method came out in hearing, so I recommend you go to the PCAF website and participate in that hearing. The method for securitized and structured products contains covered bonds, and it is 100% aligned with how we work in Europe. And the reason I know it is because I wrote that section of that PCAF methodology proposal. So these are the three parts of the three use cases we have for ESG data on covered bonds. Any questions to that on why it's important for us as a buyer of covered bonds before I I go deeper into what data we need and how our models look for, so that you understand why we need the data. Nope. So for us, sustainability on covered bonds, it is all about greenhouse gas emissions, unless it is a specific social bond under the ECMA framework. Otherwise, it's about greenhouse gas emissions. The reason why it's about greenhouse gas emissions was referred to earlier in this call about the new commissioner. It's in the EU Green Deal. It's in the EU taxonomy for ownership and acquisition of buildings. This is about energy efficiency. It's about energy composition to generate the golden number, which is greenhouse gas emissions per square meter, which will also be the number in the upcoming SBTI pathway for residential real estate that will be applicable for covered bonds. So it's all about emissions, and it's emissions per square meter that we're looking at. The way we do it is based on the EU taxonomy. So it's the EPC, the housing energy classifications. It's about how much energy is being used and what kind of energy is it that goes into it. Yes, Daniela, you have a question?
Yes, please. Just in order to understand if I well understood. So you are requiring this information for the cover pool, for the mortgages, independently from the fact that they are labeled as a green cover bond, or are you talking specifically of green cover bond?
No, this is the non-green covered bonds.
Okay.
What we do is that if a bond is labeled as a green bond, and we approve of the concept. So now I'll jump a few slides here down to the end. So in the HTT, there is a field called F1, and the first field in that, basically no one gives me that field, and I want it from everyone. That field tells me which share of your cover pool do you assess as in compliance with your green bond framework. If you put in 100%, then I will want to investigate your green bond framework. You might have a very good selection, or you might be very, very generous, and I will not approve that Nils, he can buy your green bond for our Article 9 labeled covered bond fund. So that information I need. I also need an information that is not in the covered bond, but I am doing a little bit of lobbying with Luca and company to get it into the 25 version. That is the share of issued green bonds from the cover pool. Because, now I go back to my slide from before, I will calculate based on IEA data if I don't get data from you, which I very much would like in field B15 and B16, and B20 for the golden number also for greenhouse gas emissions. I will calculate a sustainability level of the non-green bonds or the total cover pool. That the reason why it's a level and not a 1 or a 0 is because if it was a bank, I would either call the bank sustainable or not sustainable, depending on how much, how they're financing and so forth. But covered bonds, I cannot see as an entity. I can only see them as a population because there are these thousands of underlying houses. So I need to find the degree to which I believe they are sustainable in relation to the Paris Agreement. So we are using the CRREM decarbonization pathways here. And if, as in Norway, they are using quite a lot of energy, but it's almost all derived from hydro or wind, So they are sustainable. Their emissions per square meter are incredibly low in Norway, as they are in Finland. No, and Sweden. Iceland. So I will determine, so let's say it's 50%. That's the level of sustainability that I have assigned for the general cover pool. Now you issue 10% of this cover pool as green bonds. So those I would, if I agree with that you have a reasonably good framework, I would assign 100% sustainability to the 10%. But that means that the non-green bonds, they are now less sustainable because you have made a tiered system by issuing the green bonds. So you are decreasing the sustainability level of the non-greens by carving out the best properties for the green bonds. If I don't do that, I will be making greenwashing, because then the total sustainability level of the cover pool would be the 50% plus times 0.9 plus the 10% times 1. So I would suddenly have a cover pool that was 55% sustainable because you had issued some green bonds. So I need to adjust the non-green part of the cover pool down to, so that if you weigh the sustainability percentages together, I don't have more sustainability. So that's how we work with it. So we first assess the quality of your green bonds, and then we estimate the sustainability level of your cover pool. Based right now, we do it on IEA data on the countries, but we really want it from the issuers, because in our investor dialogue, they really want it from the issuers, because of course they do. So when we are discussing this with different issuers across Europe, one of the things we ask, that is, if you first of all give us the data in B15, B16, B20, and F1, and the share of green bonds. We also ask issuers if they see that their cover pool differs significantly from the imaginary cover pool of the entire country. That is, how adequate are country-level IEA data to their cover pool. Mostly, I have gotten a no from French issuers and Italian issuers, and issuers who have a large share in the cover pool that are not mortgage-based, such as agriculture, shipping, or commercial real estate. Did that detour answer your question, Daniela?
Yes, it is quite complex. I will analyze it better later, but please go on. It's very interesting.
Deep dive needs, feel free to contact me afterwards. So the way we go about this is that we already know from IEA how the energy intensity is in each country, and we know from IEA what the energy composition is. Some of energy we like, some we don't like. We don't like natural gas, we do like hydro, wind, and so forth. For the world to be sustainable, we need only 8% of the energy in 2050 to be from non-renewable sources. This is an approximation, because I would much rather have you to report in the HDT B20 the greenhouse gas emissions per square meter and per million LTV adjusted and non-LTV adjusted, but that's for PCAF. So another way we use this is for the net zero asset management methodology. So here we have taken the CRREM calculated decarbonization curves for residential real estate for each country, and then we have calculated, with the data I just showed you, we have calculated whether or not that country is ahead of the curve, at the curve, or below the curve. So if Nils, he wants to go chase returns in Belgium, which is behind because they have a decent amount of energy use, but it's all, or to a very large extent, it is fossil fuel based. Or Romania, that's the opposite. They are actually using a lot more energy than Belgium, but they are ahead of their curve. So they are ahead of their Paris alignment trajectory, at least according to our calculations. So if Niels wants his portfolio to be seen or as managed in line with net zero, he needs to over allocate to countries that are ahead of their decarbonization curves as defined by CRREM. So if he wants to change some returns from Belgium, he needs to stock up in countries like Norway or Romania. If he stocks up in Romania, though, his sustainable investment level will be hurt because Romania is still using a lot of energy and emitting a lot of carbon per square meter. So it's two different perspectives, which gives us two different investment propositions to our clients. They can invest in a mandate that is based on good status. So that would mean green bonds. It would mean countries that have low emissions per square meter. Or they could invest in change. That would mean countries that potentially have more emissions, but are ahead of the plan. So driving change. So those are two quite different value propositions that we can offer to our clients based whether or not they want clean status or affect change. Lastly, we wish to be able to report according to the PCAF standard, not by using the issuer's emissions, which might be fine for some issuers, but if the issuer is connected sourcing the covered bonds from a bank that has a lot else, then those financed emissions for the bank simply does not apply to the cover pool. So we would very much like to receive data from you in B15, B16, B20, F1, and the new field which under F1 that contains the share of green bonds that you have issued. The green field, I hope, that will be there in the next template. The status of this across Europe is rather dim. We have 146 issuers of the HTT and one of a derivative of the HTT in Austria, the ATT, but we only have a few issuers who are filling out this information, and we need it. We need it to be able to construct these sustainable investment in integrated covered bond funds that are not just green bonds. And we need it to be able to report according to PCAF, and that's something we really want to do. Any questions or comments to this? Yes, Sven?
Yeah, hi, thanks. Actually, that came to the attention that this is very important for the investors in your locations. You're referring to B15, 16, 20. I try to find those fields in the HTT. Which fields are those? Maybe we can clarify.
Under the tab B mortgage assets.
Yeah.
There are fields that are called 15, 16, 20. Can bring up an HTT. So let me just find one.
Yes, please. It could be useful.
Sure. I have one here that is partially filled out. Let me just find it here. Engagement. Yeah, so I need to stop sharing this, and then I need to start sharing the HTT. 2 seconds, it's just opening. And yes, where do I have here? And share. Tell me when you see my screen.
Yes, we can see it.
So this is an HTT from an issuer in Sweden that I discussed this with earlier this week. So in the B1 tab, the fields have numbers, and the 15, that's the energy performance classification distribution. We would very much like that, even if it's estimated, because we cannot, let's say you give us the 30% that you might have, that's the number across Europe on average. And then you have 70% that you don't have information on. I cannot assume that the distribution of EPC scores across the 30% you have information on reflects the 70% you don't have information on, because the ones you don't have information on are the ones where you haven't renewed the loan for since, I forgot when the EPC scores came out. I think it was 2010 or something like that. So the assumption is that they will have a distribution that is more towards the tail end than the top end of the EPC score distribution. But the ones to estimate it, that would be you. It wouldn't be me. You're better at estimating it. If you want to see someone that is doing this exceedingly well, you should look at Jyske Bank in Denmark. The reason why this field is interesting for me, that is because this allows us to see if issuers are having different profiles from each other within a country. So if Nils, he wants some German exposure and all else is equal, he will look to the ESG information, even in his non-ESG focused funds. So if some issuer have a tilt towards the A range, that would be preferred. The B16, that's the energy intensity of the houses. So that's kilowatt hours per square meter. I would much rather have the CO2 equivalents per square meter. That is in B20, but it's probably easier for you to get the energy intensity. So if you could give us that, we are able to better estimate the greenhouse gas emissions using the energy composition data I showed you from ECB before, and the PCAF emission factors per energy type.
Yeah.
So that's B15 and B16. Then you have B20, which is the ton of CO2 from the building's total, the same number LTV adjusted. This is the number we need for the PCAF calculations of financed emissions. And then there is the CO2 emissions per square meter, which is the data point the golden data point for both our sustainable investment methodology and our financed emissions, our NSAM methodology. Finally, you have the tab that almost no one uses, sustainable M data, so M for mortgage. That in this tab, we are primarily interested in the F11. So that's the share of the mortgages in your cover pool that would fit into your labeled bond program, being probably environmental, potentially social, or sustainability linked. I don't think I've seen any of those. I would love in this for there to be a F12 next year, which is a share of cover pool issued as green bonds, because that's what I need to do my anti-greenwashing adjustments. And this number is also about greenwashing. I have an issuer from Korea who put 100% into this field. That issuer did not get approved for Nils to use in our Article 9 funds because that is not credible. It was a general purpose bank and all of the investments were deemed to be sustainable. We don't buy that. But how can I know that, how you see it, if you don't give me the information? Did that answer your question?
Yes, now it's clearer. I have one comment on that. When we Italian banks, I'm talking about Italian banks. When we fulfill this template, we are focused on the cover pool, not in all the mortgage portfolio of the bank.
Correct. And that's what
Okay.
we need in this. This is about the cover pool's data, not the bank's data.
Not the banks, but also the other one, the other tab is on
Yeah.
the cover pool. That's
Yes,
correct.
this template is about the cover pool. And I
Okay.
do know that there is some fluidity between the bank's assets and what's in the cover pool. But what we can do, we are of course also exceedingly interested. Oh, that's shipping assets I jumped to. We are also exceedingly interested in getting an HTT for the bank's totality, but for the specific purpose of sustainability in the covered bond funds we have, it is the cover pool data that we will be using.
And yes, I have two comments, but I will try to be as short as I can.
Luca, I believe we are over my 15 minutes, so you
Okay.
control when
no worries.
when the Q&A round stops. I'm here for the
one.
duration.
No worry. I mean, I think it's important that there is this exchange. So please don't hesitate. I mean, I will try to manage time as.
Okay, one comment is that you said, okay, if you report on the 30% of your cover pool and you don't report on the 70%, we assume that the 70% has an energy efficiency level worse than the 30%.
That's what I'm going to assume, yes.
Yes, but it's in my view, in the Italian experience, is not like that, because
that is why I like you to report it to me, because now I've been transparent on what I will assume, and I need to assume this because I don't have data to prove it otherwise. And when I do sustainable investment assessments, I will be conservative. And the assumption, because the law is as it is, you only need to do the EPCs at the new loans. The assumption is that the age of the buildings that you don't have EPCs on, that is of a later date. But that might very well not be true for your bank, and I completely know that. But that's why I say, give me your assessment, and I will use your assessment. But I will not assume that they are equal. That's our choice, because we want to be conservative. And that is exactly why I'm asking for you to provide your assessment, and then I will use your assessment, even if your assessment is that your EPC scored part of your cover pool is of a better classification than the ones you have. I will still use your assessment. But if I do not have an assessment from you, then I will assume that the unrated are worse. That's to guard myself against greenwashing.
Thank you very much. I mean, Ken, can I step in here? I mean, I think that when Ken and Niels, they contacted me, I found their presentation really insightful for me, because there are different aspects here. First of all, we discover how important is the covered bond label, the HTT, but also allow me to say the energy efficiency mortgage label and the HDT, because those things have an impact on both sides. How important are for investors, how relevant. They are becoming more and more demanding. I mean, we cannot afford anymore to keep things empty. That was very clear from what I understand from Ken. So what we wanted to do today is to share this kind of need of being a bit more precise that is coming from investors, and to reflect and to digest this as a community. I will ask two things to Ken and Niels, and also to Olaf. First of all, is that in March, when we start the revision of the HTT, we would love to have your input to ask exactly what you would like to see. I think it was important to share with our issuer community their views, to let them understand exactly how they can disclose data, how they can improve data. And also there is a need in our issuer community to reflect on how to, the points of Daniel, I think, are very relevant and very important. So we need to open up the debate. In this spirit, I would like to invite all three of you to come to Tallinn for our Factbook working group. Because the HTT is not only the channel to show this communication with the community, but we have also the Factbook. In the Factbook, we have a specific investor chapter, which is very important, and probably we can involve you in the preparation of the Factbook, which is the Bible of this community. In the sense, everyone reads the Factbook. So having you involved and also probably writing something on the fact book can really be helpful for us to let our people understand where are your needs. And I'm a strong believer that sometimes 15 minutes in Teams doesn't help the community to find. We need a bit more discussion, and we need a physical discussion, and probably we need a dinner afterwards to reflect about what we said in the meeting. So I invite you, Ken and Niels, and also Olaf, to join us in Tallinn if it's possible. You will have all the best analysts there, all the best data people, and I invite all of the people that are involved to have this exchange to come. I think it's a very important topic for our industry. We need to change, and we need to change in the right way. And we have to be efficient on the way how we change. So Ken needs to understand the needs of the issuers, and the issuers need to understand the needs of Ken. That's very important for me. We are a platform for exchange. So allow me to conclude with a nice invitation. Ken, I thank you very much. I think it was very helpful for all of us. What you are saying is very relevant. We hope that the message has been passed. This is an ongoing discussion. That's just the beginning. That was just an aperitif, pre-Christmas aperitif for all of us.
Now, Luca, let me say that I appreciate very much Ken analysis. It is music for my ear as I'm working in the green bond and green cover bond, and we are going to report on the PCAF methodology, the finance emission. So we are on the same page. I was just curious because I'm more focused on the total, let's say, banking book, and this is only a part, but we will discuss. But anyway, I appreciate your work.
So Daniela, you have to come to Tallinn if you want. I mean, to discuss with Ken. That's the difficult thing. In the spirit of investors, thank you very much, Ken and Niels, for your input. I mean, I highly appreciate it. I mean, Olaf, can we move to you? I mean, I think that, I mean, you have been historically one of our inspiring brain, I would say. We try always to listen to your words very carefully. And I would like to give you the floor to share your views on how the cover bond label is helping your daily work and what can be improved and what we can do better. I mean, I give you the floor. Thank you, Olaf, for being with us.
Yes, sure. And thank you for having me and giving me the opportunity to talk to you. Indeed, we already heard this morning that the covered bond label might help also us as investor, and I think Niels and Ken, they were giving an view on how the HTT can look like in the future. I would like to give you a view how I use the HTT and the covered bond label webpage as of today in my daily work. I really do need it as the first line of investigation when I'm asked to. It's always I'm always happy if I see that it is a labeled issuer, because it makes life very easy. And this is what I want to show you in two short examples, two case studies that really are part of my daily work. Let me start with telling you how Commerzbank is structured in that case. Of course, it is on us here in Treasury to decide about the investment. We are looking for bonds only that are deemed to be HQLA eligible. However, when it comes to accounting and categorizing the bonds that we were buying, it is on the decision of our finance department, which is then ticking the box and telling me or telling the shareholders whether we really have an HQLA eligible bond or not. And I can tell you, when I was buying a covered bond and my finance department is telling me that they don't see it as being HQLA eligible, we are starting a lively discussion. And here comes the covered bond label into place. So let me share my screen here with you. All right. And by the way, what I'm usually asked for if a covered bond that I bought is not deemed to be HQLA eligible is mostly only three parts of information. First of all is whether the bond is Article 129 CRR compliant, and I have to provide some transparency information and also information about over collateralization. So now you can look at me and follow me through my daily work. It's quite easy. So I'm receiving an email like this, and I'm asked by my finance department to provide some information about over collateralization on a certain bond, and this is a bond of La Banque Postale. So I go to the issue to the label website. We go into the data pool. As easy as this. All right. Here's the bond, and here's already the first information that I need, which is very nice. It is the yellow star here that is showing me that we are talking about a European covered bond premium. Therefore, I know, and also my finance department knows that Article 129, they can tick on it. If we go into the bond himself, oh, sorry, that was a tick. I have to go on the ISIN. I have, again, the information about the EU, the EU label. Again, it is premium. And I have I already get an idea why it might not be in the database my colleagues in the finance department are using, because they are relying on WM database, WM Datenbank, as a database provider that is sitting in Germany. However, they are from time to time really lacking important information when it comes to HQLA, and this is when the label website is helping me a lot. Yeah. So it is a retained bond. It might have come via our repo desk to our LCR portfolio, and therefore it might not have been recognized as a covered bond premium, European covered bond premium in the first site. All right, now let's move on to the over collateralization. And this is when I am starting to use the HTT, or yes, let's go on the HTT graphs. All I need to do now is indeed to make a screenshot of this beautiful screens here, because here is shown that the actual OC level of La Banque Postale's bond is at 31%, while they only would have to use 5% OC. So also this information is then provided. And last not least, even if my finance department would tell me that they are not believing that this is the covered bond premium, nothing easier than that. We just simply go to the national information pool. We are going to France, and under Jennifer, we have the links to the regulator websites where they are asked to list all the covered bond premiums or European covered bonds by ISIN. We can do that, of course, also here with this particular bond. And as you can see, it is not yet on the list. However, although this is pretty easily explained, if we go back to that particular one, you will see that it was issued on the 4th of October, while La Banque de France list is only up to September. So it will be in the next one, and that is easily can be described. What I'm showing you here is in between seconds, or at least 1 minute, I gather all the data that I need to provide to my finance department. And this is really cool, I have to say, yeah. All right. That was the first short example I wanted to give you. Another one would be digging a little deeper into the HTT. Let's assume that I wanted to increase my credit lines on a particular issuer like SEB, and my credit department this time has some concerns about the cover pool and the percentage of commercial real estate, as they, of course, have analyzed the market and might have seen some more risk into that commercial real estate market in Sweden. Again, we go back to the, to the website. We choose SCB. We go to the cover pool on their own website. Yeah. All right. And then I'm looking up the information about the asset types in the mortgages. And we see here that I have no information. However, again, this is not a problem. We just simply go to the National Transparency template and I find all the information that I need here. And I can see that there's no commercial risk involved, at least into the cover pool, and I can easily pass on that information to my credit colleagues in the credit department. Yeah, this was just to give you an overview that we are really, as the investors, using the label, and it is useful for us. What my recommendation would be really to add all national regulators and the particular covered bond lists. I think there is still one or the other country lagging. This would make our life easier as well. And yeah, as I hopefully could prove, I am more than happy with all the information that you are providing.
Well, Olaf, that was amazing. I mean, seeing that you use so deeply our website is really impressive. It's, I think, an honor for us to have created this kind of instrument, which is facilitating your daily work. I think this is important for all the investors. I see that Mark was very attentive to what you were doing. So, I mean, I see that Mark Nokar was giving full attention to this. I mean, but I mean, allow me also for you to extend the invitation to our Factbook working group, Olaf. I think that, I mean, what you are doing and telling us, it's very important. Also because sometimes we got questioned why we should make the label, what is the benefit of the label. We are finding also ourselves in a very difficult situation because we have a lot of people free riding using fake HTT. I mean, we have several markets where there are a lot of fake HTT, which are, I think, undermining the value of all our community who is doing daily work, is really committed, is really thinking, you know, listening to you, making improvement. So having people that are free riding is a big problem for us. So, I mean, we are very careful. But I mean, this is an issue in some market that we are trying to address as a label committee, and we try to think. So I think that there is a space for you, for Ken, and for Niels in the Factbook. Allow me to officially extend the invitation to come. I would like to start this year the Factbook working group with investors giving a view of what they need, of how we can make sure that the Factbook, the HTT, the label infrastructure is responding to real market need. And allow me to move also to what we are doing with Bloomberg. We are discussing with Bloomberg quite intensively. We had a pleasure to be in Frankfurt on how we can speed up the exchange of information, how we can actually make sure that what is on the cover bond label website will be the full quality is also passing to the Bloomberg platform, and that investors have a full picture of this market. I think the quality will be the essence to make this asset class more relevant in the future. And we are creating all this communication behind the scenes. Sven, thank you very much for your trust and support. And you have been coming to our meeting in Reykjavik and then in Porto again. You are next to us. I think your participation is the sign that we want to make better. We want to do as much as possible facilitating the work for investors. We are also reflecting on how we can improve our website as ECBC and probably creating some link on the Bloomberg website. Allow me to give you the floor, Sven, and to tell us a bit more about this Fiji. Not everyone was aware of this when we started this discussion, so it's important to have full transparency for our community of what you are doing. Please, the floor is yours.
Thanks for your kind words, and thanks everyone for giving me the opportunity to speak to you here. I mean, I just want to pick up where the discussion just ended here, the importance of the HTT. And I mean, as a company like Bloomberg, we have like 600 cover pools on our database or so, and some of them might be old pools, which we kind of close, also give a close status, and then others are active pools, and obviously some report in an HTT format or in other national frameworks, and very often it's just investor reports also. So it hugely helps if you analyze, if you capture, analyze the data, to use that format, agree to the same format. If people report in an investor report, there's quite a lot of room for interpretation, and that is not the aim of the industry. So so coming back on my topic, what I actually want to talk about, and I want to keep it short because of the time, so I'm going to share my screen a little bit. Okay, can you see that now?
Yeah.
Yeah, perfect. So so on the Fiji, Fiji. I know not everyone has seen me speaking about the Figis, or I quite just give an overview. This identifier is now available on the HT25 template. So it's a non-mandatory field, and I want to show you here how you actually can find that Figi. So the Figi itself just should give you the ability to, if you look at so many pools as a participant in the market, either from an investor or an issuer, so that you really identify the right cover pool and be able to link all the information. The cover pool, I mean, the first thing would be to link the bonds associated to the pool. And then if there are like features of that pool, let's say it's an covered bond label pool reported, that all the bonds are linked with a data field is covered bond label. Yes, then quickly you can manage your data set. And it was actually very refreshing to hear Ken and Olaf speaking about how they're using the reports and how much they're analyzing the data. So the Figi, and now I'm taking my Bloomberg hat off, is a non-profitable organization, and it just addresses the needs for the market to be able to manage data sets. So so coming back, so we basically gave every pool we identified in the market a unique identifier, and we offer the community outside Bloomberg customers as well to use that identifier to manage the data set. So how you can find that is, one thing is you can find it on the Open Figi webpage, and I think it might be nicer if I actually do a live demo on that. So it's very easy, openfigi.com. You go on search. I leave that open for now. So the cover pool identifier we have under the corporate market sector. Just remember that like all the bonds. And then what I query here is cover pool. And I hit search. So on the website, we try to show all the pools we deem as active. So not necessarily reporting under HTT or so, just active. It could be also an undisclosed pools, but where we believe there is a pool, even if there are no bonds in it or so, just an active program. So that's how we try to identify. So we identify here 453 pools. So you can show that. It's actually quite easy if you want to export that list to Excel, and then you can map it to your data set. So I mean, if you look for a particular issuer, and we have Nordea earlier, so I just can filter now by name and get all the pools associated to Nordea. I mean, there are various entities actually as a mortgage issuer, and also some of the entities have multiple pools. So that would be the way how to find the FIGI, which is this number. Let's click on that to find that FIGI. If you look for that and manage the data set, if you enter that FIGI to the HTT, it will help people which digest that data to match that data in that data set. So if you're Bloomberg customer, you have that terminal, and here to find a particular pool, I go through our search function. I first want just to have covered bonds, and then I want to have everything with a cover pool FIGI. Or maybe gives us too many results. Let's look again for the Nordea as a ticker name. So let's display the results here. And it's the same principle here, of course. So I just make it a bit more visible. So it lists me all the bonds. I think it was like 270 bonds. And I configured that. I mean, on the terminal as a customer, obviously get more information. We link to the pools than available on the website, but the website is free and open. You also can digest that data via an API. So if you want to monitor if new pools are added to the web page, you actually can use that free API. And yeah, and while I have the opportunity to speak to you, I also want to give you a little bit a preview how what kind of information we extract from the reports and having available in the database for our customers. And I'm currently working, actually showed that to a few people also on that call, that I want to revamp our description pages for the cover pools. So so it's a way, and I think it's really good that there's competition in the market, and there's a cover bond label showing that that data, so we all can work on the same field, and eventually for every investor to find the best solution where to find that information. Are there any questions?
Then, I mean, thank you very much. I mean, while we wait for any potential questions, I would like to thank you for this presentation, which is very operational, exactly like Olaf and Ken. Today, we have prolonged a bit the agenda, but we wanted to give you this kind of a tangible touch on how useful we are. To answer to the basic question, is the cover bond label giving added value? I think that we can say proudly, yes. I think it's a very operational daily value that we provide to system providers, investors, to the entire community. This is exactly the target, the strategic target that, Antonio, I'm looking at you because you were the chairman when we designed this crazy adventure of the label. I mean, there was no consensus around the table. Let's be honest. I mean, everyone was saying, why we have to do this? Well, after 12 years, we can say that we made a difference. And I'm very proud of this journey as a community.
Luca, it's great to see the practical use of the label. And I think the combination with Florian's presentation about the market is excellent. Thank you very much.
We apologize because we planned 1 hour and actually we extended this to 2 hours and a half, but it was very important and we had excellent speakers. So all of you, thank you very much for sharing your views. I would like to conclude with the email that we sent you yesterday with the list of the events that we have. We have a busy year in front of us. The world is changing, the European Commission is changing radically, and we need to position ourselves strategically in this kind of debate. So already from the 15th of January, we will be in Vienna to the Central Eastern European Conference organized by Inviso. Thank you very much, Inviso, for their support. And we will have a covered bond debate. It's a very important conference because we will have all the Ministry of Finance and major authorities of all the region. I will be also visiting with Sergio Presco, the new president of the European Mortgage Federation, the governor of Moldova. We want to support the countries accessing the European Union, providing a financial support and probably implementing covered bond legislation. At the end of January, we will be in Canada. We will be with the Canadian issuers. As you know, all the Canadian banks are in the label, are supporting the ECBC, and we wanted to give space to the Canadian issuers to tell us what is their concern, to update them on the third-party equivalents, which is very important for this community, like the Australians, like the New Zealand. So we will be in Toronto to support our Canadian friends. And then there is a combination of two events which are quite important. On the 5th and the 7th of March, we will be in the Philippines. Together with the Asian Development Bank, we are organizing a housing conference on affordability and sustainability. It's very important. I would like to give you the strategic sense. We are moving new investors in the covered bond space. We are moving central banks. We are moving investors in Asia, moving to our space. Most of those countries are implementing Basel III. What does it mean? It means that covered bonds are becoming eligible for their LCR buffer. So when you see me going around and putting pictures on it's because I'm trying to convince central banks and investors of the regions of investing in covered bonds and, of course, implementing a covered bond legislation on those markets. Then Inviso, the Monday after the Philippines in Singapore, we have our usual Asian symposium, which will be a nice opportunity to speak to Asian investors. So we invite all of you to be there. And then the spring plenary meeting will take place in Athens on the 29th and the 30th of April. It will be right after Easter. And we are organizing also the usual pavilion where we will have a lot of startups coming to share their views and hopefully find solutions. We are very honored that the World Bank asked us to support and to cooperate for organizing their affordable and sustainable housing conference in Washington, D.C. So the EMF and the ECBC and ISMA will be fully supporting this event. We will try to bring the commissioner on housing and energy there to Washington. Then the big event of the year, as you know, the Covered Bond Congress and the Covered Bond Plenary in September will take place in Seville, in Spain. Thank you very much for the Spanish community for their support. They are doing an excellent work in funding amazing venue for us. That will be a big show, as you know, will be in Seville. Everyone will be there. And then at the end of September, we are going back to Venice, our usual Energy Efficiency Mortgage Initiative conference. But we are inserting a new date. As I said, we will have the ECBC Factbook and Data Research in Tallinn on the 12th of February. So we invite all of you to be there. And Olaf, Ken, and Niels, it will be an honor to have you in this debate because we want to capture your views not only on the HTT, but also on the Covered Bond Factbook, which is our major publication. We would like to see your names in the list of authors. I think that will be very nice. So allow me to make a formal invitation to you. With this, we would like to wish you very nice holidays. And I think all of you deserve a bit of relaxing time with your families. And it's really a friendly hug that we want to send you. We have become more important. We have become stronger thanks to your views, your comments, your input, your craziness, you know. And we have created a crazy platform where all ideas are eligible, all ideas can become reality. And I think the label is the best example that few crazy ideas can become reality and make the difference. With this, I wish you Merry Christmas. It's 11:30, perfect. I love to be German on this. I mean, we are a German community, so we are pünktlich. Thank you very much, and Merry Christmas to all of you.
Thank you very much. Very interesting meeting indeed. Thank you very much, Luca.
We will put this in YouTube and will be available. We will send you the link, and probably also we will share this in LinkedIn. Thank you very much.
Thank you. Thank you very
Bye
much.
bye. Thank you all.
Thank you.
Thank you all.
Bye.
Thank you
Thank you so
everyone.
much.
Bye bye.
Bye.
Great holidays.
Bye bye.